Okay, everyone, we'll get started. There is going to be a recording of the webinar available for you guys to view, so we'll get that up as soon as possible, hopefully sometime tomorrow. Now, some of you have been to a few of our webinars previously. This one we're doing a little bit different, purely because of the fact that we do get a lot of questions from clients, mainly regarding, how do we work, and why should we open up an account with IC Markets as opposed to any of our competitors. So, rather than tell you why you should open up an account with IC Markets, tonight what I'm going to do is I'm going to tell you what the differences between brokers are, and then I'll leave the decision up to you guys. There are some real distinct differences, and I'm going to make them as apparent as I can tonight. So we'll get started now. So this is just a disclaimer. Just have a quick read of it. The top part of it essentially says you can get a PDS, product disclosure statement, from our website, and derivatives trading, so Forex trading, it carries a lot of risk. The bottom part says that the views herein are the views of myself and not necessarily of IC Markets. So just have a quick read of it. If you do want to make any kind of investment, it's recommended that you seek independent financial advice. So it's a really great disclaimer, this one. So just a quick overview of the webinar. So the first part we're going to cover, it's the PowerPoint presentation. We'll be looking at brokers and the differences between us, how we operate, and more. We'll go through MetaTrader 4, so we'll be covering the basics, how to use the platform, place orders, manage your trades, and just get a feel for the layout and customizing your workspace. And finally, we'll finish up with some trading examples. And this will be on the Forex and equities markets. So first off, are all brokers the same? In short, no, we're not. And I'll be expanding on the reasons why throughout this presentation. The first thing to understand is that there is two types of brokers. There is two models that brokers in online broking use, and that is the market maker model and the DMA model, or the direct market access model. We have discount brokers and we have full service brokers. So the difference being, discount broker is your E-Trades and your Bell Directs, so it's cheap as anything to trade. That more applies to equities, but you do get advisory in FX, and usually the costs, the cost of the service is built into the cost of the trade. So cheaper isn't always better, and you do get what you pay for in this business. Traders think they're safe. So the reason why I'm putting this presentation together is to make you as informed as possible. So it's taken me, well, I've been trading for 5 years now. It's taken me that long to get a proper understanding as to how this business works. So when I see you guys all sitting in the workshop at Knowledge to Action, I have a bit of hindsight behind me now, and so I almost feel obliged to pass on some of the information that I've learnt being in the industry onto you guys, and it's going to save you a lot of stress and a lot of hassle. So if I give you all the information that I've learned over this time, it's going to make you all more informed and better traders all around. Okay, so again, I'm going to elaborate more now on the DMA model. The DMA model is essentially where we, IC Markets, we act as an intermediary, and that means a middleman. So we're just connecting you to the market. That's the DMA model. Then there's the other model, and that's the market maker model. And I'm sure you've heard of a market maker. So we'll be elaborating on that a little bit. A market maker, essentially, they hold onto client positions. They manage their total exposure as a whole. So they don't. What they do is they don't pass your trade onto the underlying market, to the interbank market. And I'll cover all of that in greater detail in a few slides. This is a very, very rough diagram of the DMA model. So where my mouse is now, traders, that's all of you guys, myself included when I do my own trading. So traders are here, we've got brokers, and then we've got the interbank market. So at the top here we can see when we place our trades, when a trader presses buy or sell, or they place an order, it goes through to the broker, and the broker as we mentioned previously, is the intermediary in this case in the DMA model. So picture that is IC markets. So you place the trade through us, and what we do is we connect you to the interbank market. And what happens then is your order is accepted by whichever bank is on the bid or the offer at that time. So down here we can see banks display bid and offer prices for each currency. So if you're trading the euro dollar, you can always see a bid and offer price or a buy and sell price, and that's, every bid or offer price has a bank sitting behind it. It's a bank that is willing to trade at that price. Okay, so what we do is we get a price from several large tier 1 banks. These are global liquidity providers. So we get bid and offer prices from all of these guys, and then what we do is we aggregate them. So when you click buy or sell, it could be JP Morgan on the other side of the trade, and they'll take your order. It could be Credit Suisse, it could be Deutsche Bank, it could be any number of our liquidity providers that are on the other side of the trade, and that will eventually end up taking your order. All throughout this process, we, the broker IC Markets, all we're doing essentially is providing the infrastructure to connect you to the banks, to our liquidity providers. So here at this end of the spectrum, we can see trader receives prices with ability to trade on them. Now that's a very important part of this puzzle, this diagram. Having a price, being displayed a bid and offer price is one thing, but then being able to actually trade on that is another. So in a lot of cases, what brokers will do, they will get prices from these banks, okay, and they'll display it to you, but whether or not you can actually trade on those prices is another story, and we'll cover that in more detail in a minute. But this is as broad an overview as you can really get for the DMA model. Just to go over it again quickly, trader, broker, interbank market. The broker, in our case, we're providing the infrastructure, the trading platform, all the support in order to connect you to the banks. And I'll explain why you can't deal directly with the banks in a second. So the interbank market, essentially, I'll just go back to it. The interbank market, it is restricted. Okay, so not anyone can. Okay, someone's just asked a question. I'll get to that in a second, Alvin. So the interbank market, not just anyone can actually deal in that market. Okay, it's restricted. It's restricted for a number of reasons, and those being credit. Not everyone has enough, or they don't have a high enough credit standing or rating in order to deal in that market. It is restricted, so majority of the world daily turnover in FX is controlled by a number of institutions. Okay, and they're not going to give that up to anyone. So that's an important part. So it's restricted to the banks with the highest of credit ratings. What the broker does, as I said, we provide the infrastructure to connect you to the interbank market. So what we do, we have a credit agreement with one bank. Okay, so let's hypothetically speaking, let's say we approached let's say Citigroup, and we said we want to trade the interbank market. We essentially have to have a credit agreement with a bank in order to reach that market. Okay, so we are able to trade on interbank prices through a credit agreement that we have with Citi, for example. Okay, so the bank allows the broker to trade on interbank prices with their counterparties using their credit. So the bank says, okay, IC Markets, you have a great credit, so therefore we're going to allow you to trade with us. And this isn't something that just anyone can go and do. In order to have what we call a prime brokerage agreement, you actually do need to have significant deposits with the bank in order for them to say that you do have enough credit to trade on the interbank market. So the DMA model, because we're in the middleman in this process, connecting you to our liquidity providers, all we do is we collect commission on the trade. So we don't widen the spread, although that is an option available to us. We just collect commission. We do that for a number of reasons, mainly because high-frequency traders, scalpers, and active day traders see the benefit in having a transparent price. In other words, in having us pass on the price that we receive from the banks to you. It also has certain implications on your ability to trade, and I'll show that later on when we're actually in the platform. So the DMA model, it is a lower margin model. So because we're only taking a commission on the trade, we at the end of the day do not make as much as a market maker. Therefore, we want good traders. So with IC Markets, with the DMA model, we want the best traders out there. We want big traders. We want frequent traders. We love scalpers. We love people that do a lot of turnover because it effectively means that we collect more commission on trades. Again, we want good traders. If a person opens up an account, for $10,000 and they blow it in the space of 2 weeks, we make a little bit of commission off them. If we have that client for a long time, we'll continue to generate commission from them, and they'll continue to enjoy our services. So that's a big difference as well, and I'll elaborate on why we want good traders and why other brokers may not want good traders a bit later. So the DMA model, because we are just connecting you to the market, it is the purest form. So if you were to liken it to equity trading, if you were buying BHP, really, you'd want to be connected to the marketplace. You wouldn't want to buy BHP off a broker and not actually own the underlying stock. That's as close as a comparison as I can really make. Another feature of the DMA model, direct market access model, is that we don't take risk. So because we're just connecting you to the marketplace, we don't actually take any risk with client positions. We don't carry any exposure with client positions, which is very, very, very important. All we do is make sure that our traders stick within their, their margin limits. So we manage each individual trader and make sure that, they're not going to hurt themselves. But apart from that, we actually, as a company, don't take any risk, which is really important because or you want to know that your funds aren't being used to take risk with client positions. That's very, very important. So now I'm going to touch a little bit on the market maker model. So at first glance, you see that the two are very, very much alike. So here we have traders, and then we have broker, and then we can see we've got banks here. And I've deliberately made these lines like this. It is split up. And the reason for that is because they're not actually connecting you to the banks. It's a very ad hoc process. So here we have trade placed. Trade goes to broker just like before. Broker runs a book and manages exposure using banks. So basically what happens here, when you place a trade, the broker takes the position. Now the broker has a few different options. They can either A, not hedge the position, and then they can take a position against the client. B, they can offset it within their internal order book. Or C, what they can do is they can hedge your position with one of the banks. Okay. Down here, we can see banks display bid and offer prices for each currency. So that's how brokers, market maker brokers, just like us, that's how they get their prices. Then what they do is they provide bid and offer prices that they want to deal at. So this is very important. They provide prices that they want to deal at. So, for example, they will, let's say that the euro is falling. They basically want to show a price where they can take your order and hedge it immediately. So if you want to go short, they will provide a price where they can take your order and hedge it straight away so that they don't take risk on the trade. Alternatively, as we can see in the next step, trader can execute on prices displayed at the broker's discretion. So you can have situations where you want to place a trade, and if it may not be in the benefit of the broker, there's a good chance that they won't accept it. And when that's the case, what you'll have happen is you'll have a reject or a requote, which is quite frequent if you're trying to do a market order or a direct deal ticket. And these are most prone during, around news announcements. So because during news announcements, basically what happens is you have thin liquidity in the market, and brokers, because they're not just connecting you to the market, they have to hedge their exposure. If they can't hedge because of the thin liquidity, they won't actually take your order. So that's very important. If a broker, basically, if they don't want to take risk because you might be right, you might be on the right side of a trade, if they don't want to take that risk and risk losing money, then they just won't fill the trade. So it can impede your trading style. So again, at first glance, they do look the same, but what's really important is down here. So whether or not you can execute on the prices that you see. And this is something that really becomes more apparent when you start trading bigger lot sizes. A knowledge to action client who is actually doing really well, he just attended the, I think he's doing the boot camp right now where they're going through some extra strategies. He's been trading 5 standard lots per trade, which is $50 per pip, and he's been scalping, and he's been doing quite well over the last couple of sessions. And I had to reaffirm with him today that we love it. We as a broker love the fact that he's using bigger lot sizes, and we have no problem at all with him scalping. We encourage it because we are just an intermediary. If we were a market maker, then we may have a problem with that. We may say that this guy's scalping. He's not providing us with the ability to hedge his trades. He's taking money from us. And so what you can have happen is, you might get a delayed, reaction. You might get a delayed fill on a trade, so the broker can actually hedge your order or hedge your trade. And again, that's something that mainly happens when you do start to get bigger as a trader, and you do start to become more successful. But nonetheless, it's a problem that you don't want to have. So with market maker brokers, usually the costs are built into the spread. So market maker brokers generally, they won't charge commission on trades. They generally only charge the spread. Spreads can be fixed or variable. So variable spreads generally mean the prices or the size of the spread will fluctuate, but usually that will reflect their ability to hedge. So when you see wider spreads, it means that basically the broker is just trying to cover themselves, and they want to give themselves a greater ability to hedge your trade, so they take less risk. We'll only take trade if they can hedge inclusive spread. That goes back to the slide where I said they may not fill your trade. You'll get a reject or a requote if they can't hedge at that time, because there are situations where they say we don't want to be short the euro right now. It's dropping like a rock, and everyone's hitting the sell button, and the broker's lacking the ability to hedge. If they don't want that risk, then they may not just fill you. Volatility, thin liquidity. Again, that goes back to whether or not they'll fill you, because in volatile times or times when there's thin liquidity and they lose that ability to hedge, especially fixed spread providers, they can't hedge, and therefore they will not fill you. Market maker brokers, if they don't hedge trades, they're actually taking risk. So your funds, essentially, they're using in order to trade. That's essentially what it means. So when you place a trade, they're holding on to it, and they're basically betting on you losing. So they're taking risk with your trades. If you do have a big trader come through, a good trader, you can have situations where they can cost brokers a lot of money. And there is always, with market maker brokers, a conflict of interest. So even if they do hedge a lot and they don't take a lot of risk with client trades, there is always a conflict of interest because of the fact that they aren't DMA. So there is always going to be a situation where they do make money when you lose in a lot of cases, and if they can't hedge, then they just won't fill your trade. So just to go over, DMA brokers, we take commission on trades. That's how we make money. We earn interest on client positions. So if you're if you're long or short a currency pair, we actually take, and it gets rolled over to the next day, we actually earn a small part of the interest that you earn or that you have to pay. So that's how we make money. Market makers. So market makers, they make money, when clients lose trades a lot of the time. They make money from the spread, and they make money from interest on client positions, as we do. So this is a couple of weeks ago at one of the Knowledge to Action workshops. This is an area that was touched on, and I'm grateful for clients for bringing it up, because it's an area that isn't really understood. And if you were to call up most of the brokers in Australia, they'd probably give you a very fluffy answer as to, is your money safe when with a broker? And as I said at the start of this presentation, the reason why I put this together is basically to make you as informed as possible and to give you some insight as to how how online brokers work, and just give you the facts as they are, and I'll leave the decision making up to you. So where are the funds held? Segregated client trust accounts. Do you want your broker to take risks? And the margin trading account model means your funds are pooled with all client funds. So your funds, essentially, if you call up any broker in Australia and you say, are my funds safe? They'll tell you straight away that your funds are held in a segregated client trust account. So they're kept separate from company funds. Now, this is a legal requirement from ASIC that we have to fulfill, and it's true. When you deposit funds with a broker, they get put into a segregated client trust account, but after that, what actually happens is they get pooled with all other funds in the margin account. So essentially what this means is any margin provider, so whether it be a CFD provider, an FX provider, futures and so on, any margin provider pools all client funds in order to offer leverage to clients. So I'm just going to go back a few slides so I can show this better. All traders deposit funds with the broker, okay, and this is where they're pooled together. So when we have an agreement with a bank to access the interbank market, okay, we have to maintain margin as a company. That's how the banks or our liquidity providers, especially the one offering credit, that's how they basically monitor us, and we have to meet our own margin requirements as a company. So once they hit the segregated client trust account, they're transferred to our margin account, and then we use this in order to give you leverage. Okay, and that's very important. And whether you're trading with IC markets, IG markets, CMC markets, City Index, they all operate in this same manner. The main difference being DMA brokers do have that agreement in place, and so we're just managing our risk, our margin. Okay, we're just managing it with one bank, and then accessing the interbank market. So we can never lose. A client can never lose more than is in their account. We've got risk measures to stop that. With the market maker model, they also pool funds together, but what they do is they hedge their exposure. So at any one time, they can actually be long or short currencies, and they've got exposure one way or the other, and they're taking risk. Okay, so essentially what this means is your funds are pooled together in order to help manage their risk as a company. So that's very important. So are your funds safe? It's a good question, and to answer that, it could probably be better answered by saying, does my broker take risk? Because we all have segregated client trust accounts, but what's important is whether the company takes risks as a whole. Are they a market maker? Are they DMA? And that is really going to determine the long-term success of the business and whether or not they can be susceptible to a blow-up. Do you want your broker to take risks? Okay, so I think we've gone through all of them. So the biggest thing and the biggest reason why I love the DMA model, why I work at IC Markets and why I actually trade through IC Markets as well. The reason I do that is because of the transparency that the DMA model offers me. So when I get stopped out of a trade, I know 100% that it's because I was in the wrong. I use a very tight stop because I'm a scalper myself, and I have absolutely no problem at all leaving my stops in the market. On a frequent basis, I will see price come within 0.2, so 2 fractional pips. It comes within 0.2 of a pip of my stop, and then reverses. It's done this on several occasions now, and every time I see it, I'm amazed because I know I've traded with half a dozen other brokers, the biggest brokers in the world, and it's just something that I'm not used to. So having that ability and having that transparency at IC Markets, I think it's really great. Another thing about the DMA model, it's more ethical business. So because we're not making money, when clients lose money, I think it removes that conflict of interest that arises with a market maker. And I just think when a company's interests are aligned with your own, so when a company wants you to succeed as much as you do, I think a greater outcome can be achieved. And finally, the DMA model, I believe personally it represents the future of Forex trading and all other markets, so CFDs as well. I think the market maker model is it's losing ground as traders become more educated and they become more aware of how the two models work, and that's part of the reason why I'm presenting this to you today, so you can be as informed as possible, and you can spread the word of the differences between us, and hopefully you choose a DMA provider to do your trading with in the future. So that concludes the presentation. So now what we'll do is we will go through MetaTrader 4 so you understand how to use it a bit better. And after that, we will go through a few trading examples, both through MetaTrader 4. I'll bring up another platform so you can see some equities that we're looking at as well, just so you can see how technical analysis works across all markets, not just Forex, and how all the principles that you learn in Knowledge to Action, how they can be applied to just about any instrument in the world. So just before I do that, Alvin, you had a question. What's the difference between ECN and STP feeds? Not a lot. So they're both DMA, so they're both direct market access. Essentially, with STP stands for straight through processing. Essentially, when you press buy or sell, it's getting taken by whichever bank is on the bid or the offer. So it's very, very similar to an ECN. They both aggregate prices, so they both provide the most competitive bid and offer. They are very, very similar in structure. A lot of brokers will actually say that they are STP or straight-through processing, no deal desk execution. Fact is, most of them, they're not. Okay, so I'm not going to name names because that would be wrong, but most brokers do offer a straight-through processing ability. However, you have to have an account in excess of $50,000 in order to access it. So if you have a micro account, if you have a mini account, or most standard accounts, you don't get the STP feed. You do not get to trade on the interbank prices. You still go through their deal desk, but having that option for traders gives them the ability to advertise with STP and no deal desk. But for the smaller accounts, for people starting off like most of you are, you would be put on the other feed. Working out tips, stops, etc. I made a bad mistake today, and instead of using 5 decimal points, I used first 4 by mistake, and it cost me 400. All right, David, we'll go over that in a second when we go through the platform. So thanks for your question. So I'm just going to go through the platform now, and I'll assume that no one has actually seen it before. So this is a layout that I've made myself. By default, when you log into the platform, you're going to see 4 black charts tiled across your screen. At the top here, we can see that we've got drawing tools. We can change the time frame of the chart. Up here, we've got our indicator button. We can place orders just here. Here, if you ever don't see your market watch board, your navigator board, or your terminal, these can be added or removed just here. So that's where you would click. Up here, you've got all your options to view, to see charts, all the different tools, and so on. So because most of you are going to be using eSignal, I won't go too much over the charts. Instead, I'll go through the other functions of the platform. So I'll go through, placing orders, managing trades, and so on. So first off, to place an order, there's a few different ways that you can do it. Actually, first off, I'll go through how to open up a demo account, since that's what most of you will be doing. So when you first log into the platform, or when you first open it up after installing it, just go to File at the top, open an account, and just put your details in. Agree to the newsletter. Now, we're not going to spam you. It's just a condition for you to sign up for a demo account. Deposit amount, so you can choose how much you want to start off with. So ideally, you want to simulate live trading conditions. So start off with an amount, 10,000 or thereabouts, whatever you're going to open a live account with. After that, okay, it's opening one. It's taking its time. So after that, you'll receive login and password. It's best if you write these down. However, the platform will log you in automatically every time. Okay, we'll just wait for it to update. All right, it's taking its time. So we've already got a demo account running. We'll just go with that for now. But yeah, so first off, so we've opened up a demo account. The next thing you want to know how to do is to place a trade. So here on the market watch board, these are all the currencies available for you to trade from within the platform. So it's as easy as right-clicking on the currency that you want to trade, select New Order, and that brings up an order ticket. So in the order ticket, you can also change the currency if you need to. The first thing that you want to do once you bring up an order ticket is you want to select the volume on the trade. Now, everyone that's attended this webinar, what I'll do is I'll send you a document so that you can see what the different volumes mean and how many units they represent in the market. That way you'll have a better understanding as to how to place trades and the size you should be trading, because we do go over it quite quickly now. So we'll just use a volume of 1 as an example. And well, let's just try and get into the market straight away. So this is the euro dollar. I just want to place a trade to get into the market. So let's just put we'll just do a buy order just as an example. Okay, so that order's been placed. We can see it's live now. So we can see down here, this is the terminal. The terminal is where you can see live trades, as we can see here. It's where we can see our current account balance. And if we were below this grey line, it's where we could see any orders that are open. So right now, I'll just talk you through the trade that we just placed. Here we can see the time of the trade. We can see the type, so we can see that I bought it. We can see the size. Here we've got the symbol. Okay, we've got the price that I executed the trade at. Stop loss price, which is blank. We've got a take profit price, which is blank. And this is the current spot price right now. Here we can see the commission. So as we covered earlier, because we're a DMA broker, therefore just connecting you to the market, we collect commission on trades. We don't widen the spread. Also, we can see here on the right-hand side the profit on the trade, and this is the profit just for this individual trade. Beneath it we can see the profit, which is now a loss, inclusive of any other costs, so the commission on the trade as well. One thing I will just point out, if you look at the chart, you can see I've got a red line and a grey line that's moving up and down. That shows you the size of the spread. So if you go to trading new order, we can see that the current spread on the euro is it's 0.8 of a pip. Okay, and we can see that illustrated on the chart with the grey and red line. And I'll show you how to do that to your charts later on. But that's a really effective way to basically gauge the size of a price swing relative to your spread, and it's a good way to see the viability of a trade if you're a scalper, for example. So right now I'm just going to close out this position. So all I've done is I've right-clicked on the trade, I've gone to close order, and close. Okay, that's done. That's closed. I've got a few questions. A web interface for MT4, it is possible. We are looking at offering it for clients. For those of you that are currently running a Mac. If you just hold on, we'll be able to send you out details for that very, very soon, as well as a mobile phone trading application. Does the bank get the spread? That model that I showed you earlier, where we have banks providing bid and offer prices, the banks don't collect a spread from us. So if we open up a trade, so if we press sell, so on this order ticket right now, if I click sell, okay, that order is going to be taken by one of our liquidity providers. Okay, so whoever's on the bid, whether it be, if it's JP Morgan, what happens is when we close that trade, when we click buy back, that doesn't necessarily get closed by JP Morgan. Okay, so we get the trade is closed by whichever bank is on the offer. So that's very important. You can get filled by different counterparties on your trade, so no one provider is taking the spread. The spread is basically just what our liquidity providers are giving us at that point in time. Is the charting on par with eSignal for getting started with, therefore for income generator strategies? Simon, the charting is, the platform, if you look at it, is very, very similar to that of eSignals. If I was starting out from knowledge to action, I'd definitely use the eSignal charting, and the reason for that is because our daily charts actually change at a different time to eSignals. So we're 2 hours ahead of eSignal charts. So we've got a small Sunday bar. eSignal does not have that. Okay, so at least at the start, when you're trying to get used to the strategies, I'd encourage everyone to stick with eSignal, get familiar with it, and then later on down the track, once you know the strategies like the back of your hand, you can look at changing over. But at the start anyway, I think it's imperative that you just stick to the eSignal charts and get as familiar with them as possible. When I was learning to trade, I used my mentor's charting package, which I still use, and I just use it because I saw it was what he was using, and I wanted my charts to look exactly like his. So I still use that package today. What is your commission percentage and how does it compare with spread charges by other brokers? David, that's a really great question. So our commission charge on a trade works out to be 1 pip. So most brokers would widen the spread by about a pip. We just charge a pip in commission. And this has several benefits, which I will go over in a minute. But we always charge a pip on the trade, which is, if you're trading a standard lot, it's equal to $10. If you're trading 1 mini lot, it's equal to $1. Now, I've been trading, as I said, for about 5 years, and I've traded with every major broker in the world, and I've always ever paid a spread. I've traded with the biggest, and come tax time, there is absolutely no way for you to account or to report the costs that you have incurred through your trading. And it's deceiving and it's clever because you don't know how much you're paying on trading, and it's basically it becomes a hidden cost. It becomes part of your losses. The commission structure, it offers transparency, so you always know exactly how much you're paying on a trade. So you can get to the end of the financial year and you can say, okay, I've paid this much from 1,000 trades. A spread-based system does not give you that ability. You have absolutely no way of calculating your spread. And why is that? The reason why is because brokers widen spreads. Okay, so they widen spreads depending on basically their mood. They might be behind in their quarterly profit results, so they want to widen it a little bit. They have that ability. The market might be a little bit illiquid, so they want to widen the spread so they can improve their ability to hedge your trade. So a variable spread, it fluctuates, and there is absolutely no way for you to account for that at the end of the financial year. If you were to try and squeeze out of a market maker broker how much their cost was in the spread, I'm pretty sure they wouldn't give it to you. We're giving you our cost, pure and simple, with a ticket fee that you receive on a trade, which is always equal to 1 pip. So thanks for that question, David. So right now what I'll do is I'll go through a common order that you're going to use with the knowledge to action income generator strategy, and that is a stop entry order. Now that document that I mentioned earlier, that's going to cover how to use the stop entry order in more detail, but I'll just go over it briefly with you just to give you an understanding as to how it works. So when you, first off, let's say we wanted to buy the euro at this area here, should it break? So we wanted to enter the market at 132, let's say 75. That's this area it's just around here. So 132.75, if the euro trades there, we want to be a buyer in anticipation that it's going to head higher. So to do that, it means that we're buying above where the market is currently trading. If we're buying above where the market is currently trading, we're using a stop entry order. So we're trading on a break of this high here. A lot of knowledge to action strategies, the income generator, the main one, use stop entry orders because they trade a break of the previous day's high or the previous day's low. So you will have to become very familiar with stop entry orders in the future. So right now we go to trading, we go to new order. Okay, the first thing I'm going to do is I'm going to change the volume to 1 because it's a $1 million account and I can afford to risk that much. I'm going to change it to, or the type of trade or order, to pending. The next thing I'm going to do is I'm going to change the order type to a buy stop order. Okay, so again, a buy stop order means that I'm going to buy the euro as it breaks this high. Now the next thing, I'm going to put in the entry price, so 137.75. Sorry, 137. Let's say 137.30. Okay, next thing, I'm going to put a stop loss. So let's just say I want to put a stop loss below this low here at 137.05. And we'll put our take profit at, let's just say 138, just as an example. So now, just to go through the order ticket with you one last time, I want to buy the euro dollar if it breaks this high, so it's a buy stop order, which we can see here. The entry price is 137.30, which we can see just here. Okay, our stop loss 137.05 down here, and our take profit at 138, which is way up in the clouds. So I'm going to place this order. Okay, order placed. So now we can see the order is down here beneath the grey line. We can see that this box here is it's light up, or it's lit up, and it's lit up because the market is trading close to our entry price. So entry price here, stop loss price here, take profit price here. Okay, so we'll leave that open. So that's the main order type that you'll be using with the knowledge to action income generator strategy. What I'm going to do now is I'm going to show you the next tab along here. It's called account history, and this is where you'll be able to view all activity on your account. So right now, I only opened up this demo account today, so I put on a few quick trades earlier this afternoon just to give you something to look at. But I'm showing all history on the account to date. So if I right-click in this area and I go to Save as Detailed Report, Save, it's going to give me an account statement. That's really easy. Anyone can do that, and you can do it as often or as frequently as you like. This is what the account statement looks like. So you can see IC Markets at the top. It's got my name there, currency of the account, and this is the date the account was or statement was produced. Then we can see all of the trades that we've taken on the account. So we can see how we're performing constantly. With IC Markets, you can have as many demos as you like. So you can have a demo account for the income generator strategy, for the pivot strategy, for the sniper strategy, for your own strategy that you've developed. It doesn't bother us, and you can account for all of those separately, and you can see the effectiveness of each one. And that's a really good ability to have. So here we can see I've got a commission column, so I can see all the commission I've paid on trades, and we can see the cost on the trade. Again, if we were a spread-based broker, you wouldn't be able to see any of that cost at all. The net difference, or overall, the difference between a spread-based broker and a commission-based broker is going to be very, very small. If anything, I believe you're going to pay less with a commission-based broker, and I'll explain a bit later. But effectively, your net P&L is going to be the same, but at least it gives you the ability to account for it, so you can see exactly how much you're paying on your trades. Over here, we can see how much profit or loss we're making on each of the trades as well. Down here, we've got an equity curve, so this is for any realized profits and losses on the account. So you always have the ability to look at this after every trading session, every week, every month, so you can see how your account is doing in real time. And that's a really great ability to have. If you start to see this curve look anything like that, probably a good idea to stop trading and give someone at IC Markets a call or at Knowledge to Action, and they can give you a bit of help with your trading and try and identify what's going wrong. Down here, you've got some great statistics, total trades, total number of winners, your average win, your average loss. All of these, again, are really critical to your success in the market. You want to keep an eye on these, and this is probably one of the main reasons that I switched from MetaTrader to MetaTrader 4 from my existing platform, part because of the DMA structure and partly because of this reporting, which I think is great and unparalleled so far in the online broking world. So we'll go back to the platform. So here we've got our order. It's still in the market. What I might do now, because we are running out of time, there's only a little bit of time left. If anyone has a question that they'd like to ask, please ask it now. But what I will do is I'm just going to show you a few quick examples of what we're looking at in the market. So I'll show you some trade examples, some recent trade examples from IC Markets, covering both equity and FX markets. So I'm just going to pull up another platform. So this is another platform. It just gives us the ability to look at equities, and we do a lot of equity trading at IC Markets. And what you'll be able to see here is how technical analysis works across all markets, not just the currency market. So here we'll start with a stock called Bionomics, which is a pharmaceutical company, and this is a stock that we're currently watching. We're watching it because we understand that there is a takeover offer in the making, and this, we can see clearly this is an area of resistance on the chart. I just want to zoom out a little bit to give you a better idea as to what it looks like. But this is an area of resistance on the chart, which Knowledge to Action have told you. So every time it's come to this level, it's been sold off, sometimes rather aggressively. But right now we can see that it's made a lows and it's consistently making higher lows, but it's retesting this area here. So this is a trade where we think it could break out. And this is a setup that you see constantly in the Forex market where it retests a level, and in this case it's making higher lows, and we can see that breakout to the upside. Some other stocks that we're looking at. This is one called Molly Mine. So you can see a similar setup where this area here in the chart, it's $1. It has acted as a bit of resistance in the past before eventually breaking, and we can see far higher prices. So that's a typical breakout scenario. Here we can see a pattern that knowledge to action teach you about. It's called the triangle pattern, and it usually occurs after a run up or down. So here's a perfect example of a triangle pattern followed by a breakout. This is a current stock that we're holding, CJO. So we can see here it's had a run up, and this represents quite a few percent of the stock since it was currently trading or previously trading around 12.5. So it's had a run up, it's made this triangle formation after a run up, declining volatility before it breaks out again. Similar formation here, and it's broken out again. So we can see that the triangle formation, especially in equity markets, is a really useful one to use. Here we can see just simple trend lines and how they're working. The market was well aware of this trend line resistance as it moved up to it and eventually broke it. This represents a 40% rise in the stock in a single day, which is it's massive. And it had to get through this resistance here, as well as this resistance on the chart here, in order to really break out. Here we can see another example where a stock is making a low, it's making a higher low and moving up towards this resistance, just like that Bionomics did. Came up to the resistance, looked a little bit weak before eventually punching through. So that's why we like that pattern so much, because it does work quite well. This is a chart of a stock called Dexus Property Group. So if we go to a daily chart, we'll see the effect of a stock or even a currency pair that's been consolidating for some time. Usually it will lead to quite a breakout. So here in the stock we can see that it's been traveling in a very narrow range between low 70s and high 80s for some time. And it's finally looking like breaking out of this range, as we can see here. And right now it's just above these highs, and we're waiting for this stock to show some follow-through and really head higher. Another example of a stock where it's trading on this trend line. It's bounced off it a number of times, and we're looking for this one to head higher to the resistance and eventually break out to the upside. So that's a few examples of some of the stocks that we trade and a few examples of technical analysis in action. I've got some questions now. So how long does access to demo account last for? It lasts indefinitely, so you can have access to it for however long you like. You can open up as many demo accounts as you wish, so you can test out all your different strategies through them as well. David, how did you get that account statement again? So to get an account statement from within the platform, down in the bottom right-hand corner in the terminal area, you can see it says trade. To the right of that, you've got your account history. Click on that. In your account history, right-click and go to Save as Detailed Report. Detailed statement, you want to save that. Replace, and that's going to bring up an account statement with all of your stats. Now, this is a detailed report, not just a detail or not just a statement. So make sure you click on Detailed Report so you can see all the useful stats and your equity curve. Is eToro a DMA platform as well? eToro is a hedger. So what eToro does is they hedge once every, I think, 3 seconds. They send an order into the market hedging all exposure. So they're not a market maker, but they're not what we would call a pure DMA platform because they're a hedger. So they constantly hedge exposure. They don't want to take risk as a company, and they constantly hedge in order to do that. So it's not pure DMA, as is the case with the MetaTrader 4 platform that we offer, but it's very, very similar too. They operate on a similar model where they don't want to take risk as a company, and that's probably the safest model to run, and what you want your broker to employ. So they don't take risk. So it's almost time. Does anyone have any other questions before we wrap it up? So this is just, I just saw this opportunity now. So this is the Aussie dollar, and this is a pretty interesting looking chart. We just saw on those equity charts how price came up and retested an area on a few occasions. Aussie dollar is doing the same thing with this area here. So right now we can see these highs here. It's made a low, it's made a higher low, it's looking to retest it, and we can see that break there. So that's probably one you want to keep an eye on if you plan on doing some trading later tonight on your demo or live account. It'd be interesting to see if we see the Aussie break. We did see it get sold off yesterday, and that was on the back of the New Zealand earthquake. Actually, this is a 1 minute chart, so if you go to the hourly chart, it's probably going to give us a better picture. Okay, so that's giving us a better picture, but we saw it get sold off yesterday, and that was because of the earthquake in New Zealand, as well as the deteriorating situation in the Middle East and North Africa as well. So that's one to keep an eye on. How do the bid-ask lines on the charts? Okay, good question, Alvin. So this is a 1 minute chart, and it's especially useful to use the bid-ask line on a 1 minute chart. So all I've done, if you right-click on your chart, you go to Properties, go to Common, and go to Show Ask Line, and that will give you that red line there. You can actually choose the color of your ask line here, so it says ask line orange, red, and you can also choose the color of the bid line. Gray is a little bit difficult to see, but we can actually turn off the grid, and that makes it a bit easier. So this way we can see how close our orders are to where the market's currently trading. Okay guys, well it's 8:30, so I think we'll wrap it up there. Thanks everyone for attending. If you do have any questions, you've all got my email address, so feel free to send me an email or give me a call, and more than happy to help. I'll post this video up for you on a website tomorrow, so I'll send everyone the link. So I encourage you to go back through it if there's anything you didn't understand, and to have another look at it, and we'll try to help you after that. So thanks again, guys.